Hi there, my name is Josh Lerner. I am the chair of the entrepreneurship unit at Harvard Business School. And today I'm going to be talking about some research that we have just finished up looking at the globalization of angel investing. It's clear that there's been a dramatic growth in the amount of angel investing taking place. It's certainly true from the statistics that have been prepared about the United States. But when we look at many other countries, the statistics, particularly on angel investment groups, suggests as well a process of very rapid acceleration. In many senses, whereas before there might have been a small seed round before the venture capitalists would come in, today when we look at companies like, for instance, in Uber, we see a whole series of financing rounds by angels. And even after the venture capitalists come in, angels are major investors. In some respects, this is not surprising in the sense that angels have many of the benefits of venture capitalists in that they fund early stage entrepreneurs, they typically do detailed due diligence, and then they serve as mentors and sometimes even as outside directors for the entrepreneurs they fund. But at the same time, they avoid some of the problems that venture capitalists have. In particular, as we know from a lot of academic research, because venture capitalists are investing other people's money, typically not their own, they're essentially prone to what economists will often call agency problems. In other words, they may take a company public too soon because they want to go out and raise a new fund, or they may be so motivated by the fees associated with a larger fund that they basically end up raising too much money. Because angels are typically investing their own money, they avoid these problems. At the same time, certainly there have been questions raised about angel investing. And in particular, one of the critiques one hears from venture investors is that, well, the venture capitalists are professionals, angels are essentially amateurs, so perhaps they don't have a kind of judgment that venture capitalists do, or they might be scared off for really risky bet the world kind of investments that sometimes the Googles and the Facebooks, at least that's what the venture community sometimes says. So we sought to really understand what was going on with the globalization of angel investment, and in particular to ask a couple questions. First, did we see angels making a difference in terms of the companies in which they invested? And secondly, did we see patterns in terms of the impact of angel investments in different countries and in the also in the kinds of companies that they were funded? To do this, we worked with 13 angel groups that are based in a dozen nations and considered applicants or firms seeking funding from 21 separate nations. And what we did is we looked essentially at the companies that were considered and rejected, as well as the companies that were considered and then funded. And again, this is known in the financial economics research as a regression discontinuity approach. Essentially what we're doing is if there's some sort of cutoff above which the angel groups are funding these companies, we're comparing the companies just above and just below the cutoff. Two groups that are very similar in many respects. They all went out and sought angel financing, and they were all essentially voted on by the angel groups as being relatively similar to each other, and then comparing the outcomes and how much the angel financing made a difference. So essentially, we looked, as I mentioned, at groups in a wide variety of countries, and they were certainly very different in terms of how developed the venture market was, how the legal regime was, how friendly it was to entrepreneurs, and so forth. These groups, we asked them to at least have been active doing angel investing for several years, to have detailed records, or at least to be able to compile these on both the applicants that were funded as well as the ones that were considered and rejected, and to actually have information not just simply on the transactions, but also on how much interest was expressed by the angels in the group during the evaluation process. So this is a very thoughtful set of groups. I mean, this was a big ask that we were making to them. So as such, it tended to be a group that, was sort of groups that were meticulous in their record keeping, that were thoughtful, that understood research, just a fabulous group of funds. While we got great information from the angel groups, we had to address the issue that in many cases, we had a lot of information on the companies that they funded, but the companies that they considered and ended up deciding not to fund, they had much less detailed information on. So we essentially went through a process of very carefully hunting down and searching these companies down. We obviously used information online in the various databases of small firms like Bureau van Dijk's Orbis database, the patent records and venture capital databases and the like. But we actually spent most of our time really hunting down these hundreds, in fact, thousands of companies on a case-by-case basis, calling them up, speaking to the entrepreneurs, and getting the crucial information that was there. It was a time-consuming process, and certainly it was a little painful, but it was worth it in terms of what we ended up finding. In any case, the angel groups during the period we had looked at essentially had considered roughly around 1,700 companies. The typical applicant had somewhere on the order of 10 employees or so, and was seeking to raise around $1 million. So as I mentioned, that's the whole range in terms of companies. Then what we did is we narrowed it down to roughly the several hundred companies that were either just above or just below the place in the voting in each case, which seemed to be somewhere around the cutoff. If you looked at many groups, the companies that attracted very low angel investing had a very low probability of funding. The ones which got a lot of interest from the angels had a high probability, and there was often some sort of range, some sort of cutoff where the probability of getting funded dramatically increased. So we essentially looked at just below and just above that at the roughly 600 deals that fell in these categories. So we essentially did this comparison and then asked, what did we see in terms of the features of the companies that were just below and just above? And what we found is that the companies that were, very similar to the ones that didn't get funding, but did just squeak by and get funding, tended to survive for much longer periods of time. They were much likely to undergo a successful exit, whether IPO or acquisition at an attractive price, and they were much more likely to go out and raise subsequent financing. So it was clear that the angel financing made a big difference. What we also found, which was interesting, is that this was as true in countries where venture capital was well developed and where the legal regimes were friendly to entrepreneurs, as it was in countries where venture capital wasn't well developed, a small share of GDP, for instance, and where the legal regime made it much harder, for instance, to start a business. That it seemed that the positive impact of angel investing was essentially seen both in venture-friendly and venture-unfriendly places. It actually made a very substantial difference in terms of the companies. It's also not surprising that in addition to surviving, the firms that got the angel financing that were just above the cutoff essentially thrived as well. They were more likely to hire, for instance, additional employees. When we looked a level deeper, though, we did see that there was one difference between the countries which had large amounts of venture capital funding and were generally entrepreneurially friendly and the other nations. And that had to do with the mix of companies that were going out and seeking financing. In particular, when we looked at the companies that were approaching the angel groups, in the countries that were less well developed in terms of the share of the economy that venture capital represented, or were less friendly in terms of starting new businesses, what we found is that the companies that sought out angel financing were more likely to have considerable number of employees and to have already gotten into the revenue stage or even the profitability stage. The businesses tended to be both more mature and larger in terms of the headcount. Yet at the same time, they also were asking for smaller amounts of money. So it was sort of paradoxical that we saw these were at once better developed businesses, yet they were asking for less money. It's almost as if they were engaging in a process of self-censorship, where because it was a tougher environment to raise money, when they approached the angel groups, they waited till longer and asked for less money. So that was one striking difference that we did see across countries. So just to summarize, it's clear that angel investing is an activity which is becoming increasingly important around the globe. We looked at 13 angel groups who considered transactions in 21 different countries. We found that the angel groups had a very positive impact on the companies which they funded in a way that was true both in well-developed and much less well-developed markets, and ones which were more and less friendly to entrepreneurs. We saw that the impact was really uniform in terms of all these measures, yet the mix of companies that were going and seeking financing was quite different. And in particular, in the less well-developed venture markets, we saw that firms tended to be older and sought smaller amounts of money. To us, this is intriguing because it does underscore how important the angel phenomenon is, not just simply in Silicon Valley or here around the Boston area, but as a global phenomenon. This is something that's positive and important in many different markets. At the same time, it does suggest a whole series of interesting questions that we hope that we ourselves, as well as other researchers, will be able to explore. One of the questions is, do we see other differences in terms of how angels operate across different countries? And in particular, do we see that the angel groups are using different contracts, for instance? We've certainly seen in terms of research around venture capital that the kinds of deal structures look quite different depending on how well developed the venture market is. Do we see the same thing on the angel side? Similarly, does the kind of intensity of the oversight that the angels provide after the deal is done vary with the state of development? And perhaps most intriguingly, given that today we're seeing in many countries around the world a burst in terms of the formal venture capital activities. Think of the kind of growth that we're seeing in India and China in terms of venture activities today. How are the angel groups adjusting and adapting to the arrival of their brethren, the venture capitalists? So I think that while this study suggests a variety of exciting things and underscores our feeling that angels are an extremely important part of the entrepreneurial ecosystem, it also raises a whole series of questions that will reward research going forward. Thanks for your attention, and thanks for the participation in the study.